Tim Quast, good morning, sir.
Good to see you guys. Well, that was an interesting discussion. And yes, I've missed you, Spencer. We haven't talked since June.
I know, it's been a couple weeks.
I know, Tim. We've missed you like crazy.
I grew a beard well, it's what you do so there are 2 times a year in Colorado where you want to be bearded. And one of them's summer and one of them's winter, of course.
Why do you want to be bearded in the summer in Colorado?
Well, because you're out hiking, kayaking, rafting, road biking, mountain biking, all of that stuff. You don't have time to shave, so that's why we do it. Of course, the bad news for me is Dennis, I'm not well enough known to have other Dennis Dicks or other Tim Quasts running around.
Don't be surprised. They'll get you, Tim. They're gonna get you.
But but it keeps getting grayer. That's what's dispiriting to me. So but the good news, it'll be hard for somebody to fake the aged visage that I've got. You're timelessly you're timeless there, Dennis. You don't age.
I don't. I'm actually aging, so I'm aging inside. I'm outside a little bit too. My hair is crazy, but I thought I was losing my hair 20 years ago, and it's still the same. So I'm getting lucky, I guess. So.
Well, let me know your secret.
I don't think I have any.
Trying to hang on to hair, all right.
His secret is no natural sunlight. That's
Yeah, I just stay in like the little dungeon cave. I'm not released from this like trade cave ever. So
avoid the sun at all costs. All right, Tim, we got some earnings
yes.
this week finally, and
right.
What's on your radar for the week?
Well, and I'll preface it with something that Blaise Pascal, the French mathematician, made famous back in the 17th century when he said, "I'd have written a shorter letter, but I didn't have time." Meaning, you'd like to be brief about things, but it's hard on the spot to do that. But you're right. So earnings typically kick off with the banks. So J.P. Morgan, Goldman Sachs are on the docket, and probably other banks later. I just looked ahead to tomorrow, and Pepsi report. So you tend to get blue chips, and I think it's always informative to look at market structure for those big companies. Certainly, they're not the kind that are going to give you, extraordinary returns like the meme stocks, but those, of course, come with risk. So I'll tell you what those indicate. And for those of you who don't know what market structure is, they're to me two essential ways to look at stocks, technically and fundamentally. But then what brings those two ways to think about stocks together, how they trade and how they perform as businesses, is the rules that govern how they trade. That is the universal. It's the great equalizer. And market structure is the behavior of money behind price and volume in context of rules. Price and volume are not metrics, they're consequences of what's occurring. So if you're measuring consequences to try to understand what's occurring, there's a risk. There's a risk in technicals. There's a risk in a market where if you look at financial returns to tell you how a stock is going to behave, I give you the FANGs. So the FANGs have crushed it and we're down. Then the FANGs, all of a sudden the FANGs are great. And we're talking again about the great rotation from value back to growth. Well, what if it's none of that? And I can tell you why right? What if it's none of that? So let me show you what these things look like through the lens of market structure, because again, it's the great equalizer. So if you want to follow along, you can go to marketstructureedge.com and you can put your name and email in, and you can see this. That's all you have to do. And you can see what I see. This is what I do every day. And I go look at what the data indicates. So here's, it's July 12th already. It's hard to believe to me. Another sign of advancing
I know.
age.
The years just fly by here, Tim.
Just incredible, isn't it?
Yeah. It's a problem. It's a problem because the years keep going faster and faster. It's like I'm starting to realize that I'm like really 90% through my life, because when you're like 5 years old, the time goes so slowly. And like you technically, like, you're only, I guess, 40, 80, you're halfway there. But really, when I look at it, I'm probably 90%, because those years when you were sitting in school when you were 6 years old, that clock went backwards and never moved. And now the days and the years are just flying by so fast. It's like you flush the toilet and, the top of the water is going slow, but the bottom of the water is going really, really, really fast. So anyways, I feel like I'm in the bottom of the water and I'm almost flushed.
It's
terrible analogy.
It's a terrible analogy, and yet there's there's an element of verisimilitude, which means there's truth in it, right? So, I follow you. That's the old adage that you get 70, and everybody I know who's 70 has really slowed down, and I'm not that far from it. It's just frightening how fast.
You're still a young buck, Tim.
Yeah. Well, I'm trying, right? That's why I'm in Colorado. But so let's look at these things. Here's the first thing I would do. I like to put whoever's going to report results into a portfolio, and I want to see these things. What is market structure sentiment? What's the balance of supply demand relative to the axis of 5? And which direction is it going? So if we just take Pepsi here, it's 5 and it's bottomed at 5. It's bottomed at the nexus of supply and demand. The market will tend to do that. It's about 39% short. That means 39% of trading volume comes from borrowed stock. In the S&P 500, it's about 45%, pretty close to that, 44 to 45. Trades about $11,000 at a time. Passive investment behavior is the leader. So that's going to be indexes and exchange traded funds and quants. There's the price. It's in the consumer staples group. So then I want to go look at these data and see, well, what's it been doing? Nothing. Look at this line. It's right at 5. This is very much what core stocks like Pepsi will do. They will be at 5. They're difficult to trade profitably because of that. But if you're a hedge fund, you can trade it profitably by being long and short. So notice what happens here. Sentiment stays at 5. If you're going to get gains in price like we did here in early June, it will correspond with lower short volume below the trend. So the hedge funds shift from 47%, 53% short, 47% long to the reverse of that. And then as soon as the price goes down, then they shift short and short volume moves above the trend. And that will repeat itself over and over. Very difficult if you're a long short trader, this is the way to do it. You don't ever have to take any risk. You just have to follow that trend. If the short volume is below the trend, you should be too. If it moves above, you should be too. And you too can be a quantitative hedge fund. Now, if we step back a little further, I like to do this. Let's go back 3 months. That's about a quarter. Behaviors change every quarter. You don't want 20 years of data. I'm sorry, that doesn't work in today's market because the rules all changed. You go back 20 years ago, we were just implementing decimalization. We want to look at the market under the current regimen. But once again, you'd have to go back up more than a quarter to find a good time to trade Pepsi other than long short. So what's it going to do here? Not much. There's my prediction. It's not going to move much. And notice the price has really stayed between 145 and 150. Why? Because market structure has never given us a balance since back in April that indicates more demand than supply. That's what it requires. So traders, that's how to think about it. You want to trade Pepsi, trade it long and short, and use the trend line and short volume to know where you should be. But you can't expect a big move. So let's go to Goldman Sachs.
Yeah, earnings on Tuesday, tomorrow.
Tuesday, right? Tomorrow. Exactly. Maybe I should go back here and say, let's look at the same things again. So it's 7 and down. So it's gone. The sentiment is a bit above 5, but it's migrating back toward 5. It's not very short, 36%. Clearly, nobody's betting against it. Trades about $18,000 at a time. Active stock pickers, fundamental money is in Goldman Sachs, as you would expect. Why would we expect that? Because people expect that Goldman Sachs will do better than the consensus from Wall Street, the street. So now will it? Well, let's go look at the data. And I doubt I'm going to disagree with that. So I click the icon over here to look at the data. I like to back up 2 quarters because why? Because 2 quarters ago, financials were all the rage. And look at how much time Goldman Sachs was spending above 5. So you'd buy it when it ticks above 5. And look, it spent all this time above 5. Here's sentiment begins to drop. I probably, leave about the time short volume popped above the trend there. As long as it's above 5, it tends to rise. But right there where short volume pops above trend, I'm out. Could you come back here? You could. As soon as it returns to 5, better is the uptick because there are the returns. And then you stay until you have a downtick or the rise above, if a short volume above trend, and you leave again. You could do that and you could make some reasonable returns. So where is it now? Well, sentiment is above 5, but it never got back to 10. It doesn't have that momentum that it had before.
Right.
And it's begun to decline. Short volume is below trend. That tells me it will get some gains, but we're not going to see what we saw 2 quarters ago. And I'm not sure that people are expecting that. I think that they think the banks are going to do great again. And I look at the data from the banks and they look like this. So would I trade those? I'm not good enough to, like you, Dennis, to trade those.
Huh.
You would have the acumen to do it and the speed to do it. But for me, this is a risky trade. You might get a couple of 3 days of gains because short volume is below trend. But this tells me that the market's verve is diminishing. I've used this analogy. It's like the velocity of money. It's something the monetary policy thinkers and the economists like to talk about. The velocity of money is how often it moves around. The more people are spending their money, the more velocity there is in money, and the more opportunity there is for commerce to occur and things to grow. When that slows down, economies tend to slow down. And if you look at the stock market, it reflects declining velocity. And I realize there are a lot of people who are saying, well, we've had a great first half. There tends to be a great second half when there's a great first half for stocks. There are plenty of reasons for stocks to grind higher. I get all of that. But those are all things that they're all ideas that don't necessarily reflect supply and demand. Here's the broad market. If we take the S&P 500 composite stocks and compare it over the last 6 months to SPY, the ETF proxy for the S&P 500, look at the amount, see how sentiment was, this is velocity. So sentiment pops above the 6.0 red line. That's where you remove some money. It comes back down and bottoms, put more money back to work, remove some money, put money back to work, remove some money, put money back to work, remove some money. Ooh, oh, now what? So the whole trend line has lost its verve.
Yeah.
To me, this is something that tells the people like me who think about market structure, the weird guys with the wild hair and the gray and beard, that is a dangerous condition. I think that I've said this since April, that I think the market is setting up for a surprise. The difficult part is I don't know where it comes. This tells me, though, that money has stopped moving. And at some point, that's going to create real problems for the equity market. And it's not predicated on fundamentals. It's not created. I could give you all the arguments against it. The earnings are going to be great because you have tremendous comparatives versus the second quarter last year.
Yeah,
that's going to be awesome. Fed is providing great support. Congress is providing fiscal and policy support. All of those things are occurring. And yet I look at this and it reminds me, I like to reference old people like Blaise Pascal and Thomas Gresham, advisor to the Tudors back in the 17th century too, who coined Gresham's law, who said if you create cheap money, bad money, and you say it's worth the same as the good money, the gold and the silver, what will happen is people will absorb all the gold and silver and hoard it and spend the cheap money. And at some point, there will be nothing left to buy. Then prices fall. And I think that very thing is playing out here. So what would I do as a trader?
Yeah, that's what I was going to ask you.
Question.
10 to 20%. 10 to 20% of my resources, I'm in things only with high probability, rising sentiment, flat to falling short volume. Otherwise, I'm not trading that market.
So you're still spooked here. Even though the S&P made a new all-time high on Friday, you're still spooked because what you see here doesn't support that. Exactly
right. And that's not uncommon. It is not uncommon at the peak of the market for the market to give you a false sense of security. It did it here. It does it routinely. There's a top, the market shot up. But it wasn't a great time. Then we gave a bunch of that back. I'm not saying, look, I'm not predicting that the market's about to fall apart, but one day is not a trend. To say that the market goes up, the Dow goes up 400 points, and yet sentiment's going the opposite direction, which thing will I believe? prices are capricious. Prices can be set by machines that don't want to own anything at the end of the day.
Right.
Sentiment is a good read on supply and demand. And I can see that demand is weakening. And if I look across my whole dashboard, every sector except healthcare has rising short volume. And so that means that the supply is increasing and demand is diminishing. Those things tend to produce unexpected declines, and options expire Thursday, Friday, and then next Wednesday.
Tim, does the platform account for retail activity at all? Because as somebody in the chat pointed out, still the retailer traders, maybe not entirely, but like some parts of them, they tend to move in packs.
Oh, yes, they do. But remember, almost none of, I know as a trader, because I actually pay a commission, not a lot. I pay a commission at Interactive Brokers so I can see where my trade executes. So since September of last year, I have had 3 trades execute at an exchange. One of those execute, and I trade fairly frequently, not like you, Dennis, but I'm an active trader. And those 3 trades, one of them occurred in an NYSE RLP. That's called a retail liquidity program. So a high-speed trader was paid 3 cents 100 to take the other side of my trade. And it was a market trade. It was a marketable trade, meaning I submit this to execute at the best bidder offer between them. And the other 2 were at IEX, and they were also market orders. No limit order is ever going to be at the stock market. And what do the brokers tell you over and over and over, retail traders? Always use limit orders. Now, why do they do that? So they can sell it. That's why. They can sell it to somebody else. But that's who the parties that are going to get that order flow are fast traders. 98 to 99% of retail order flow will be consumed by Citadel, Virtu. Hudson River Trading is now getting into that business. By the way, I had a lengthy exchange on Twitter about 3.5 years ago with Doug Sifu before they bought what became the Knight Getco combination. And that's what Virtu bought. And I said, Doug, you can go buy retail order flow and furnish it to a retail liquidity program. And he said, if we could do that, we would be in that business. Well, they're in that business. That's what they did. Once they bought that, they realized, oh, yes, you can. So you buy retail flow from Robinhood and you turn around and you're paid to furnish it at a better price at the exchange. That's the only way that your order flow as a pack gets to the market. The reason retail packs of order flow can cause a stock to rise is because Citadel or Hudson River Trading or Virtu can manufacture stock to fill the limit orders. We've talked about that before. In fact, I'm doing a boot camp on it for the Money Show this time around tomorrow. I'm going to explain how meme stocks work at 3:30 p.m. Eastern time tomorrow. And it's free. You could come to it. Just go to moneyshow.com and you can come see that program. But I'm going to talk about how that works. And I think everybody should understand it. You should know as a retail trader what happens to your order. Where does it go? Because then you can turn it to your advantage. You can watch your own effect in a stock where there's a rise in short volume and sentiment is rising. That is order flow being manufactured to fill your trades. When that goes down and when it returns the second time, you better be out, because now the high-speed traders know that the supply and demand in limit orders has reached a nexus, and then the stock will go down. And it happens very predictably in meme stocks, which you can track right here on Market Structure Edge.
All right. Tim Quast joins our show every Monday to drop knowledge and tell us all about where our orders really are going or aren't going. MarketStructureEdge.com is the platform. Link is up on the screen. Tim, always a pleasure. We'll talk to you again next Monday.
See you in a week, guys. Should be interesting.
All right.
Thanks, Tim.